Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone, and welcome to MacroEdge Radio number 61. This is John Galt speaking. As the room begins to fill up, I repeat, we shall start and get everyone going with our usual market update. As our special guest tonight, Samantha LaDuc, will be joining us in just a moment. This is going to be fantastic, folks. We're going to go into the macro side of things, but we're going to talk markets a lot too. First and foremost, let's hit the Dow up 238.56 to 46.758, but off the highs with an intraday reversal. S&P 500 up 44 cents to 67.15. Nasdaq down 63.54 to 22.780. Volume was impressive again. We seem to be building to some sort of crescendo with the New York Stock Exchange, 5.7 billion, Nasdaq 10.7 billion. The most active was penny stocks again, but we've come to expect that in the world we live in because we're trading in a virtual reality existence, and you guys are just participants. Okay, gold up 40.80 to 39.09, another amazing move to all-time highs. Silver up 159 to close the week at 47.97. Keep in mind the all-time high was in 1980. Yes, us old people will remember that at 49.21. Big new mover in the week is copper. Dr. Copper up 16 cents to 5.11 as there is a shortage developing across the world. WTI crude up 40 cents to 60.88. Brent up 42 cents to 64.53. Bitcoin, only mentioning it because it is pertinent to tonight's discussion from a different perspective, up $1,710 to 122.280. 2s, 10s, 55 basis points unchanged. 10s, 3s up 2 basis points to 16 basis points. Is everybody ready to rock and roll and get in depth into the news, into the reality, into all the data that you're not going to hear from the BLS because they've been temporarily fired? That's correct. Joining us tonight is the fantastic Samantha LaDuc. We love having her back on. She has been one of our favorite guests that's been on. She was so good the first time. We had to have her on again. Love to make this a quarterly thing. LaDucTrading.com. At Samantha LaDuc on X. If you're a FinTwit geek, you get it. And if you're not reading her Substack, you're an idiot. Sign up for it. Samantha, welcome back to MacroEdge Radio. Uh-oh, can she hear me? There we go.
Thank you so much. Yeah, can you hear me okay?
You sound fantastic. Please take it away. Give us your initial thoughts on everything we've seen since last time you were on the air.
Oh, no,
which seems to be pure insanity. Go ahead, please.
Way too far. First of all, it is Samantha LaDuc. Just to correct you a wee bit, it has been a while since we last spoke, so I really appreciate that. And yes, I am the founder of. Oh, don't worry about it. Don't worry about it. I am the founder of LaDucTrading.com, and I run a financial research firm. I've got a fabulous bench of 10. And as you know, I do not work alone. So we've got from classical economist extraordinaire Jeffrey Fouvre to our options mentor extraordinaire Hans Albrecht. And I've got a team of fabulous traders, analysts, and we support a whole bunch of clients navigating all of these asset classes across all time frames. So I'm happy to talk about macro or micro. Hit me with your questions, and we'll see where this goes.
Samantha, I apologize. I didn't lie when I said we start happy hour all day down here, but I appreciate that.
I thought it was going to be a 5 o'clock, and I'm like, it's 8 o'clock. Oh my goodness, Boston's already 2 drinks in. So, but you're
pretty much
time. You're just getting started. I get it.
Absolutely. Well, here we are right now with the BLS on vacation. And have you noticed any measurable difference in the data we've received? Actually, ADP, which most people don't understand, is a private data reflection of payroll reporting from companies, actual corporations. But most people dismiss that report because, let's face it, their methodology has been somewhat questionable over the last several years. Now it's the only thing the markets had to depend on, and it was ignored, even though it was a really ugly, ugly report.
Well, I've written a lot about this. This is actually something we talked about in the last spaces, where last year in June of 2024, and then again, I said it in December, and then again in June of 2025, I basically keep going on record saying, I can see that employment will take front and center as the labor market will start to weaken underneath, but the market doesn't see it yet. And that will pull forward recession risk by end of 2025. So when we had Trump come in and start with the flurry of, the tariff terrors and trade war, it pulled forward the recession risk. And I use that word, that phrase very specifically, recession risk pulled forward, because as you know, we need GDP contraction, for 2 quarters, and it's in a row, and it's usually in arrears where they make the call, but you can always tell when jobless claims start to move higher. And I have a particular level, which I gave last year, and I'm still looking for it. We haven't hit it officially, which is 267,000 jobless claims. We need to get and stay above. And it's not a one and done. We have to get and stay above, and it has to trend higher. Now with the government shutdown risk, Friday night end of week thoughts, I keep really focused on what's going to happen with the labor market, because we had a cushion in 2024 when we had the surprise non-farm payroll print for their August date, and that was before the September 18th, 2024 Fed rate cut, surprise 50 basis point Fed rate cut, which was 1 year ago. That was because the labor market was weakening. There's no question. And now fast forward, we had a revision of 919,000 this past August 2025 revision, and then the Fed followed through with a 25 basis point rate cut. And my contention was that they would cut, but they would not cut 50 basis points, because it would send a very clear signal that they're much more worried. It would basically pull forward that recession risk again. So they didn't do the 50 basis points. And now they're stuck, right? Too little, too much. And, the pressure from politics, all that aside, gold started spiking very strongly as soon as Trump fired Lisa Cook. Fed independence is in the crosshairs. And that is, by the way, by design. We knew coming in that the policies would be very much to devalue the dollar so he could pass more and more tariffs. And I still contend that is the route it will take, except for maybe a trade. But for the point of the recession risk pulled forward, it's here, and it's much more visible to me now because we have lost the buffer. So we had, when I started tracking this, several years ago, going, I'm not worried. It's not about M2, money supply. It really is the labor market and inflation, of course, but they have done such a big effort of policy intervention during Biden and then also Trump, to the tune of, again, April 9th, right after we had fallen, 21.5% coming in, and they have had to delay the tariff terrors by 90 days because the credit market, the bond market, the equity market convulsed. So they don't want to do that again. Right? They realize the power of, okay, we cannot have a rate of change yield spike of 4.5 days that triggered the 10-year from 3.9 to 4.5% because things break. So they backed out of that, that posture and calmed down, and the market got very excited and realized, okay, now we're going to the moon here because they're going to come in and intervene. We got Taco, we've got the Fed put, we've got the Treasury short duration. Who cares what the numbers look like, right? Nobody cared. Nobody cared about the employment numbers. So then when they came out with the revision of job growth down 919,000 in August, right before the FOMC, the market still had the opportunity to price it in, but they didn't. So that's really what I'm watching right now. Is it isn't as much of the Fed rate cuts, are they going to be priced in or priced out? It's whether or not we're going to get trusted data and economists are stuck. There isn't a better source. It's a funnel. It goes from states to the federal. And we can use a little bit of jolts and, ADP, but they're not good enough. And I'm using St. Louis Fed. They've actually got some good employment data and some real GDP data. But for the most part, we're really stuck with blinders on. And as you know, the market loves that. So it's climbing that wall of worry with lots and lots of reflexive, recursive, actually, kind of positive feedback loop. And it will come to a screeching halt at some point, but that's the nature of a positive feedback loop. It keeps feeding on itself. Traders buy because the indices are rising, and it causes them to buy even more recursively because of the positive feedback loop until the next external shock occurs and takes us out of our, kind of state of complacency. And so that's what we're waiting for, aren't we? And I think it's going to come from the labor market.
I'm beginning to wonder, though, we're starting to see some very concerning signs from the commodity market, not just gold and silver. Everyone's been focused on that, but tin, iron ore, copper, as I just mentioned tonight, and also many other of the base metals are beginning a trajectory which may offset energy prices reducing and create bigger issues as we try to bring this manufacturing back home. I'll go back to the employment in a minute, but the other side of the Fed problem is the inflationary aspect that the administration refuses to acknowledge, but I like to use the Atlanta Fed measurements. The sticky CPI seems to be a fairly constant, well thought out measurement. What is your opinion on that as far as a challenge for the Fed? Because it seems that we're being pressured into a 1970s, not identical, folks. I'm not calling Powell Arthur Burns by any stretch of the imagination. However, the Nixonian approach of the administration is we want a dollar devaluation with low interest rates, and we want the Fed to take responsibility for that. What's your take on that?
Well, I don't see the 1970s, the second wave, but I have seen it, of course, floated as a potential. The first wave, and it was significant because of an oil spike. And many are reminded that a lot of, turbulence, especially recessionary impulses, have been triggered by commodity spikes. In this case, we're having our spike in gold for all the macro reasons, fundamental reasons. But as it relates to oil, I'm not a bull. I don't see that as driving the next kind of inflationary wave. But I do see inflation entrenched, so very sticky. And we know on Main Street, Wall Street does this rate of change of inflation, so it really it disguises the facts, which are we continue to have compounding inflation on prices. And we can have these deflationary impulses, but as it relates to prices going down, no, I definitely am still in the inflationista camp. I also don't see yields falling very aggressively, like in a deflationary impulse. That's a hard landing type of scenario, right? Because so much supply of treasuries, short duration, has just continued to flood the market under Yellen, under Bessent. This is keeping term premium very, very supported. And there is no reason for holders on the long end to seriously consider the long end because of the inflationary expectations moving forward. So inflation is entrenched, full stop. Gold is helping with that, to show us that that matters. And for all kinds of other reasons, especially the de-dollarization is slow, but it is about this, what Jeffrey, my colleague, calls the external drain, very common in emerging markets, but for US, it's kind of our first time since the 70s, where they are doing trade, obviously, settling in gold outside of the US dollar, outside of US treasuries. We know that demand has fallen, and outside of the petrodollar. So global demand for oil is falling, and in its place, there has been a definite substitution, if you will, and push into EV. So rest of world is benefiting those who, especially China and their mandate, but in less reliance on oil. In fact, so much so that China's now, they've always been kind of the marginal buyer of commodities and oil, but they actually control the collar, the pricing. So they have driven so much of this rotation into gold, precious metals, metals in general, but also the falling value of the dollar, that it's de-dollarization, it's debasement, it's de-dollarization, devaluation, and debasement. It's all of it. So this is actually helping, of course, for things to have things, meaning the commodities, to have much more value. And the debasement trade also makes kind of objects appear larger. So NDX and Bitcoin and the rest, the NASDAQ is obviously advancing very strongly as a result too. So I think the focus on dollar as it relates to falling demand for dollar, oil, falling demand for oil is going to be actually a trend. And I know that that's not very popular, but it is still my contention. I've had it last year. I've had it, through the sell-off that we had February through April. You noticed that we also lost, yields fell, oil fell, and the dollar fell. So we have this, fiscal dominance backdrop. Monetary dominance is what we know as most, hedge fund traders and the rest are still, even private equity, they're still measuring everything based on monetary dominance, and it's just not the way forward. So I think it's going to trip up some repricing of equities in the new year. But for right now, we have still this pricing of melt up, not melt down, until we have a macro trigger to interrupt these bullish flows. And I still think it's going to come from employment, but from employment breaking, weakening significantly, not from an oil spike or from spiking higher inflation. I think it's going to be more prices stay sticky and rise while the economic growth contracts. And so far, that is being, that's kind of been my guardrail, and it's still working.
I would say, to be quite honest, it's quite accurate. Also, you brought the word debasement up, the debasement trade. We saw Luke Groman talk about that this week on FinTwit for all of us geeks and geekettes that love this kind of discussion. So let's introduce that to everyone. I think a prime example of that is Argentina, which got a loan from America, promptly turned around, sold soybeans to China, probably in dollars. So China gave them treasuries for payment. Why not, right? They don't want to hold all these long-term debt. They get soybeans. They get rid of some of our treasuries on the long end. And Argentina is able to repay some of the loans they owe us in dollars. It seems like there's a new trade where it's avoid the dollar at all costs unless you're a debtor nation to the United States. And that creates some interesting problems because the creditor nations, like you said, are going out and buying hard assets like it's going out of style. I have never seen since my trading in the precious metals, which I'm a dabbler, not a serious trader, the move to hard assets in this way in my lifetime. It's even more dramatic than what we saw in 79 and 80. What do you think is going to be the net result with these nations taking that step forward? Is your theory about the dollar coming home really starting to come true? And the dangers that occur from that, as you outlined last time you were on our show.
Oh, that's true. We did talk about that. Money comes, money, money goes home, money stays home. Right now, we still have this, I would just call it what it is, which is this positive feedback loop right now that still attracts dollars into the US equity market. I'm more focused on this bifurcated, okay, that's Wall Street, and it's extremely tradable. And gold, silver has been a phenomenal trade because central bankers need gold to circumvent the US dollar. And the dollar is by design falling. And by the way, that's helping Trump, facilitate even more tariffs. That was all a thesis early, right? Before he even came in. Like, this was going to be absolutely policy of devaluing the dollar. It helps their initiatives tremendously, also with inflating our way out of debt, quote unquote. So we've got this front and center where commodities are now under owned, and Bitcoin has now become kind of, I don't know, the light has been stolen a little bit from all of that fervor, which was front and center when Trump came in. And it's still doing fine. I mean, price wise, right? Bitcoin, Ethereum, and all of this hubbub around crypto treasury companies, but that's still a very speculative, money excess, crack up boom type of philosophy that interests a sector of people. But the ones who have been waiting, anticipating the real, convergence of things over paper, hard assets, they're in their heyday right now. They're having all of their immense bullish precious metal resurgence proven right here, because it's been the best performing asset class. Gold, silver, miners. I mean, GDX is up 153%. I mean, they're getting a lot of bang for their buck right now in holding real things. This is not going to change, I don't think, by central bankers overnight to kind of change this macro trend, but I don't think it's contributing to inflation. I think it's an off ramp. It's because of inflation. So this is the problem. Inflation is Bitcoin was an off ramp for malinvestment, some would say, but the point is you're speculating. It's not really used in goods and services. Gold, at least, and silver are in jewelry, but the point, or in central bank, reserves, but they're not really used. And so we have to kind of find out how high can this go? This inflation off ramp into gold to circumvent the US dollar. It's had a really strong run. It's just starting to go parabolic. What does it know? What does it know that's coming? We haven't had this type of activity since the 1970s, when gold literally ran from, what was it, $50 to 850? So we're there again. There's no question about it. The stagflation that occurred in the US in the 70s is here again. I don't think it's going to be driven by an oil spike like we had then. I think it's going to be very much metals.
I also believe the stagnation in economic activity will continue to suppress hiring, because as a corporation, whether you're and most people think of corporations, the Wall Street, the S&P 500, et cetera, but the actual driver of our economy are the companies with 50 to 1,000 employees trying to push forward. And in the environment we're in, with uncertainty in DC, the absurd tariff war, which is expanded further. I haven't even addressed the tariff issue with you yet. We will get to that. But it seems to me that this is more of an uncertainty trade based on the instability or projected instability we could see in the next 6 to 9 months. And I'm going to publish an article tonight, and I'll share it with you. That's going to be in the MacroEdge website about gold. Everyone thought the same thing in 2010, that, oh, it's going to stabilize, retail's into it now, it's not going to go higher. And it jumped almost 50% immediately. So the idea that retail is just now getting into the trade could take it to greater all-time highs. However, it's not going to happen instantly, folks. It takes time. That's what makes me nervous. We're having everyone pile into various assets without any understanding as to why those assets are accelerating in price.
Well, I think in the case of the metals trade, there's a lot of macro tailwinds, of course. Central banks are leading. There's also a great case in that, for miners. They're absolutely having their best earnings run ever, especially since, 40% of their operating costs are energy, and those costs have fallen considerably, while their underlying asset of gold and silver, et cetera, is rising. So I think that this is going to be a macro tailwind until either trade deficits get balanced, or we have some fiscal restructuring, right, in our government. And that's the interesting thing right now that I'm actually trying to play with, is a potential pullback in October for the precious metals. I'm just talking a pullback because we have a kind of form of fiscal restructuring underway right now with the government shutdown. So the government shutdown obviously creates many, many furloughed employees, government workers that can become, by the way, very easily fired, and departments that can be restructured and or let go. And then all the contractors that are correlated to this government engine. For every one government employee, there's, slated 3 government contractors. So we could definitely have an economic contraction from a prolonged shutdown. And Trump's not afraid of that. He's done it before. We did it 35 days back in 2018. But more to the point, he's got lots of power right now, right? All 3 branches. He doesn't have power over the purse. And so this is actually helping him tremendously. So I think he's actually going to be very willing and able to let this run longer to get that power, and well in advance of the midterms, right? We'll talk about the motivations and timing for that. And that actually would create potentially a short-term pullback in gold and bounce in the dollar and a little bond trade higher. And I'm a big bond bear, right? So I really think yields are going to stay sticky, but they're not going to fall out of a range. They're going to stay in this kind of range. And if we get too hot or too cold, then we've got issues. But for the most part, that has been playing out. We have definitely stayed within a range with the 10-year yield, and employment has started to weaken underneath. But term premia is very strong and not letting, inflation expectations weaken very much. So we're not really going to have bonds fall apart right now, but I think that we still have a very bearish currency and a very bearish bond market. But for the short term, I think in October into end of year, we could have some of that do a little reversal and a short-term trade as we're working through the government shutdown. So that's a little bit of it's a working thesis right now. I need to see some actual proof of it. But for right now, the government shutdown is a reason for the season for some fiscal restructuring. And that is really the only thing that would kind of cause, that I can see anyway, that would cause gold to come on down.
We tend to agree 100% because I wrote earlier in September that I thought we would see a correction. It did not occur yet. And being the gold bug that I am, I do believe that 4,000 is a realistic short-term peak, even if it's intraday. And I see 10% easily at some point, probably next 30 days, paralleling what you were talking about with a dollar rally and a bond rally. The thing that's got me interested about the bond rally, and I wrote about this myself and talked to Jeffrey about it a little bit, I see a chance that the Japanese have blown and made a Jay Powell-like decision by not raising rates when they had the opportunity to. And now they're trapped, and I can see the yen weakening severely, increasing the strength for the dollar and also reviving the carry trade. There's a lot of dangerous cross currents that a lot of people don't look at. You and your team do a great job looking at it. We try to do a good job at MacroEdge also. What I'm noticing is these short-term opportunities, and I look at the 10-year having a floor of around 350. We break through that, the markets have crashed. So odds are it's going to trade in the range like you discussed.
Yeah, mine's
3.6. So we're close. Yeah. We're close.
Yeah. But I don't think it's going to be very, very quick to break. So I really don't think so.
I don't think so either. I think what you're saying is absolutely correct. I think we're going to see stair steps down in yields. At the same time, we're going to see a lot of action in the currency markets, which is a dangerous proposition for people who are engaged in short-term trading.
Well, they will always adjust. That's the thing that I find most interesting about traders. They're really, they're just looking to make money. And honestly, it's not about what is good for the economy. They're very much focused on what's good for their bank account in trading the Wall Street melt up. But Main Street has some issues. So I posted earlier, I think it was today, that the U.S. stock market is, $26 trillion larger than it was the day before ChatGPT was launched, right? So we're talking 50% larger, but the real US GDP is only 1.5 trillion, larger, and it's well below trend growth. We might have a nice, solid, positive nominal GDP print that comes from a lot of this AI, CAPEX, and government, gravitas, but real GDP, inflation adjusted, is by St. Louis Fed measurements, is just a hair positive, very close to falling into negative territory. So this is the bifurcated, situation. And at some point, the real economy will matter. And that's why I focus so much on the labor market and yields and dollar and obviously oil and metals. But for right now, I think this is your point, right? Where we have got this incredible opportunity here to make tons of money from the market. But we're really, at the end of the day, worried about economic growth that's sustainable. And right now, the government shutdown is on my mind because we lost that buffer zone of support the past 2.5 years. We don't have really the flexibility to do the QE like we have in the past. That is very inflationary now. So we don't have that buffer. Printing is definitely stimulus checks, all that stuff that they're talking about is very inflationary. We don't have, forget a conducive Fed. It isn't about cutting in the short term. It's about the long term and still staying very, very firm. In fact, I'm a steepener gal. In fact, December, I said, we were zero, right below zero. We went positive, and I said, I can see going to 90 basis points, which is positive for the 10-year, 2-year by the end of this year. We're not there yet. It's probably going to be a first quarter 2026. We've hit 0.64. So, we are still rising in that steepener, and I can see this still moving higher. So I'm definitely not a yield bear. I am definitely worried about the labor market and these furloughed workers getting fired, the contractors from their programs getting disbanded, and then how is the private sector going to pick that up? That's the short-term pain is how do we actually catch them so that there isn't a contraction of size? And that's what we're looking at right now. Everyone's focused on, of course, this amazing money-making opportunity. I mean, it doesn't matter if you're trading metals, if you're trading NASDAQ, if you're trading crypto. I mean, even value had its day, right? Small caps are trying desperately to break out into all-time highs, even if 43% of their constituents are unprofitable zombies. It doesn't matter. Everything's going up, right? Everyone feels so good. And yet that's when we get very, very complacent. And that's when we have a macro trigger of some size. Geopolitical, what the heck is going on with 900, one-star generals and admirals and above coming for a powwow or a pep rally with Trump and Hegseth, and then all of what's going on with Europe. So it doesn't necessarily feel like we know what the gray or black swan would be, and you absolutely cannot trade with that. But it is something that I think about: real economy and risks, tactically long, but macro bearish.
Fantastic. SamanthaLaDuc.com, SamanthaLaDuc.com. Also, folks, MacroEdge.net/Ozone, MacroEdge.net/Ozone. 2-week free trial. Check out our new products in real estate and institutional investigations and investments. We are growing the team, growing our abilities, and we do want to communicate with fantastic guests like Samantha because it provides alternate opinions that are fact-based, not based on pumping ABC stock or any penny stock like you see on television now, which seems to be the only purpose of financial TV. Bringing that back, I think that Main Street is an extreme danger, like you said, because most of the people are not hedged and they've resorted to gambling, be it casinos online, sports books, poly market, or zero DT options. We have not had a substantial problem in markets that most of us have experienced in our lifetime, where you lose 12, 14, 16% in less than 30 days. Is there a lesson to be learned from the past that these people are probably going to get in a very rude way as we progress through the rest of this year?
I think, folks, this is a learning planet. Folks are flexible. They'll figure it out. I'm excited that, we have so many more traders, since COVID, and many, many, many women. So we have a lot of younger people now involved. And this is exciting. I mean, the growth of options, the growth of the trading networks, the lots and lots of speculation is par for the course, especially with younger traders. And then as they get a little seasoned, what's the saying? There are old traders, there are bold traders, but there are no old bold traders. So it's all this evolution, which I think is very exciting. So I'm actually very, I'm bullish as it relates to financial literacy and analysis and all of the great tools that would make our job potentially easier, but as it relates to the blinders of the raw, we have only melt up, right? We're going to have, no issues. I mean, you've seen forward estimates, right? Analysts now expect the S&P to post record earnings every quarter over the next year, after massive revisions higher, where we've pulled forward so much growth in AI and in data centers and the rest, that it's very uncommon to have these increases in forward estimates. It's very uncommon unless the economy is coming out of a recession, right? It's also very uncommon to have cutting at all-time highs, cutting of rates at all-time highs. So the Wall Street's bullishness of future earnings is nothing short of incredible. Is it sustainable? Right? This is the question. And I would say, honestly, the same thing I wrote back in June, right? The market's pricing in melt up, not price down, not meltdown, because we have AI narrative driving this sentiment and positioning the story stocks. Before it was crypto, now it's AI, robotics. The Trump tariffs were ignored, and that was I think a shock for a lot of folks. But there was still plentiful liquidity. There was the promise of rate cuts, right? Removal of Powell and loss of Fed independence. There was just this bullish flow of mechanical buyers. We have massive option dealer positioning, and we have the quant market, and we have the CTAs, which right now happen to be fully satiated. So if we do get some selling, selling will beget selling just because of these algorithmic quants. We have corporate buybacks, which are ginormous. So we have mechanical buying that assists. It's not just retail glomming on, right? And riding this wave. We can stay overbought for a long time. And I'm very focused on my cross asset analysis work is basically kind of looking at breadth and liquidity to see, is there anything that's interrupting this flow? And I keep going: June, July, August, September, October. It's the same kind of daily mantra. Nope. We had the policy intervention. They continue to promise policy intervention. So the path is paved. It's a yellow brick road. Everyone wants to get on it. And now the folks that have been reluctant, fearful, maybe rightfully so, because they can actually anecdotally see that Main Street is not doing as well as Wall Street, right? And 97% of tax receipts, which are, by the way, very bullish, are paid by the top 50%. I could go on and on about how bifurcated it is between Main Street and Wall Street, but they're still just looking at, tight credit spreads and fiscal spending, which I think at the time we talked about the all gas, no brakes. We might get a break right now, break. The government is braking. So, I mean, as a car brake. So, before it was all gas and no brakes, and now we got a shutdown. How long is that going to last? How is that going to hit, labor market and GDP contraction? But I think overall, the reason for the season is honestly dollar falling is very, very helpful to this asset appreciation. No question about it. Asset prices will rise, gold commodities will rise, real estate has stayed bid. It's helping Trump with the isolationist plan, which is rising U.S. tariffs, falling U.S. dollar, falling U.S. consumption is all helping to create this backdrop of you make it here, you can't make it anywhere, you must make it here. And even if we have the short-term pain, this is a policy choice. And we're just living in his world right now as it relates to navigating this dollar devaluation. So the yield curve is going to stay very firm. I don't see it falling. Equities will get re-rated when we have a macro trigger. Corporate profits are clearly focused on the AI ecosystem, and the rest of the S&P, universe is flat. And basically, employment is the reason for the season for recession risk getting pulled forward, and that will trigger a growth scare of size because we have such concentration risk in the index weightings for the AI, big tech. So I don't think we're going to get a deflation impulse until we can get a solid rise in jobless claims over that 267,000 that lasts for a while. And by the way, that happened in 2007. It took a year before we had a great financial crisis, right? Where markets crashed 55%. That took a year of jobless claims rising before the market finally took note and said, oh shit. So we're kind of, we could be here and have this talk, next quarter or 6 months from now and be at 8,200.
You're spot on. In fact, 2007 has been an example I've been citing, which is why I think we're going to see a further rollover in rates in the short term. Like you said, stagnation is to be expected with an increase in rates next year. But I think the increase in rates will not occur until we see a dedicated effort to pour sovereign bonds onto the market at the long end. In the short term, you have no reason to buy a bond beyond a 10-year yield. There is no practical reason to hold that for 10 years unless you're a sovereign, unless you have to trade with the United States. That brings me to the other credit risk that's hanging out there. We're starting to see some fraying on the edges, and that's private credit. We saw a tricolor and it's fraud. That is the one thing I'm wondering, is that the grayish swan that could scare markets? Because you see it, that not only is a reflection of speculative risk in the subprime arena, but also what the hell's going on at the regional and community bank level that we don't know about because we're not making an effort to discover it, and we're trying to conceal it, not just from investors, but from the public as a whole.
No, I think it's a great point. Even if credit spreads are tight, doesn't mean that credit quality is good. And that's really where I think Jeffrey and yourself and others are kind of narrowing in. Also a reminder, the Fed does not create the recession, credit cycles do. So right now we're bidding for everything. And at some point, this credit cycle will come in and start to kind of reprice some of those faulty expectations in private credit land. But it doesn't, it's not big enough. In other words, it's concerning. It starts there and then it moves into like the ABS market where we saw the auto lending bankruptcies of Tricolor and First Brand. And then it starts to widen credit spreads a little bit, but it's still not enough to really create the repricing, or I should say to price risk in. So fraying at the edges needs follow through, just like, any chart, right? But that's where I think it's going to get interesting, is where the credit quality has been degrading and it's not priced in. So will credit lead equity or will equity lead credit? Either way, there's clearly a case, and I know Jeffrey has been documenting this in great detail for our edge clients. It's a repricing of credit. And this is going to appear next year. So you can see it in the consumer lending sector, right? We've been chasing these short of late. The buy now, pay later. There will be a Carvana, come to Jesus moment at some time. But the point is, you have consumer lending that is starting to filter through into repricing of the banks that are associated, as well as the consumer lending space. It has weakened at the big banks, no question about that. He's done a lot of work on this, and now that those opportunities, of course, are picked up by the wildcatter banks, right? The SoFis of the world, and that's very exciting. And people get very excited about this new opportunity. But at the same time, the credit quality is poor, and that is harder for those who are not looking to see, because they just see the price of SoFi. It just keeps rising, and it's very exciting. But they're actually the trigger before the repricing, because consumer lending is weakening. So this is a theme. Long story short, just like private credit can have cracks, employment can have cracks, consumer lending sector is clearly having cracks. Credit quality will trump these tight credit spreads. And we already see it in real consumption. Personal consumption growth is decelerating. And it's already fallen from 2.8% in 2024 to 1.9% this year. It's expected to drop even further to 1.2%. I'm not making that up. That's BIS, right? So BIS is, tracking some of these concerns. And then we have some great analysis by others that's very focused on student loan, delinquencies, or the auto lending space. But overall, it starts here at the edges and then moves in. So you get, private credit risks that then become warehouse exposure risks, that then become haircuts on US Treasury and unwinding and hedge fund risks. And by the way, hedge funds are very short US Treasuries and very long VIP stocks, right? The Mag 7, the Mag 10, the AI ecosystem. So remember what happened in April? It was just a week and stuff imploded. So it can happen very, very quickly. But right now it's at the edges. So if you look at, the Apollo stock or KKR, or, you can see that they're starting to weaken. You can see that the consumer lending banks of Capital One, you can see the mortgage lending players as well, like Rocket. You can see them starting to get hit, even some regionals as well. And this is the thing that we now have to be alert for, which they can expose credit, systemic risks. But it's at the edge. And so no one's really worried about it. So I guess in closing, I would say I focus on growth rotation. So if I see a growth scare about to happen, growth value is an intermarket ratio that I track very, very carefully. And then all this macro stuff that we're talking about right now, which is private credit problems, are harder to track. So I refer to experts who do that. Okay. But when growth starts to roll over, everyone expects now that value is going to take up the baton. No, that's not how it works. It's very hard. You have in lieu of sector rotation, you will have volatility, and the small caps are not going to be strong enough to compensate for the weakness in a growth scare. So credit spreads then immediately widen. Hedge funds immediately start to unwind their UST shorts and their Mag 10 long. Remember, that's a pair trade. And then what happens? You get higher yields. So you and I are both in the camp that from this government shutdown, we're going to have potentially, a bond spike, maybe dollar spike, maybe gold pukes a little bit. But this is not the trend, right? That's a trade. Ultimately, when we get hedge funds unwinding their massive pair trade of Treasury short and Mag long, then you get higher yields and you get higher cost of financing, higher term premia. Then you get the equity volatility, the bond volatility, the credit volatility. This is where we look for on the edges so we can position and protect against the volatility that follows. And yes, the yen is part of that. In fact, I think that was one of my, Friday night, I'm walking about kind of thinking about this as it relates to the government shutdown and how does that interplay with a yen carry trade unwind part 2. So this happens when yields drop with oil as hedge funds unwind their treasury shorts and NDX longs. This is exactly what happened July 19th into August 5th of 2024. And it can happen again. So I think we're getting closer to it's time for a growth unwind, but the market doesn't see it yet.
Someone who follows logistics moves sharply, and I pay great attention to that. If people are starting to pay attention to logistics and warehousing, you see that there is a slowdown, pronounced slowdown, and that because of the uncertainty in the tariff wars, the trade wars, et cetera, people are paring back their purchasing expectations heading into 2026. And that brings me to one final question for myself before I get to some listener questions, Samantha. Are you as sick about hearing the quote unquote cash on the sidelines garbage as I am? Please rant away.
Nothing. I just ignore the stuff that bugs me. Honestly, there's so many other things that we can focus on. But that's not worth, it's always going to be there. It's always a bull narrative. And honestly, I think a better metric to track is margin debt. So as it rises, fear not, the market is fully, engaged. When it starts to roll over, that's when it's time to worry. So I focus much more on margin debt than I do money on the sideline. There's also a lot of plumbing that's involved in that. So again, I'm not an expert, but I do follow Fed liquidity and other measures of liquidity. I can tell when the market is in buying mode underneath the surface because of ample liquidity. And then when we start to get tremors there, and I'm looking for the cause, but I go backwards. I'm actually looking for the narrative. Why are we having the tremors? Why is breadth breaking down? Why is liquidity breaking down? And I'm looking for the reasons, for the seasons for that. I actually do not see that right now. So I'm telling you, I don't see FX volatility. I do not see treasury volatility. I do not see equity volatility. It's not under the surface right now. That's how strong the market has been. And I'm very good at finding those inflection points. So that's it in a nutshell. Money on the sidelines, I could care less about. I really want to focus on the appetite for risk, and when it's time to de-risk and navigating all those turns. That's my game, much more so than just sticking to a very, very lazy narrative of money on the sidelines will come in. No, actually, money on the sidelines might be used to afford higher electricity bills, or they're not measuring the same thing, that we're measuring. So I think that is just kind of a lazy bull argument, and it's one of many.
I agree 100%. Now, we've got Amanda Goodall in the room, and her and I discussed this. So a question was asked of one of our team, the mismeasurement of the gig economy or the lack of viable measurement. Now, MacroEdge will probably take a crack at this because if you put data out there, we'll try and sniff it out and report on it, and hopefully it validates in the long term. Do you think the inability to factor the gig economy jobs and their actual net pay to the contractor, for lack of a better phrase, is of any importance when you do your labor market analysis?
Not particularly, no. But I'm not like Melody and others who are very, very focused. Job chick, I love her. They're very much in the weeds of this. So I'm looking at the trend, and I can't show you because we don't share charts, but I'm looking at the trend of job growth. I'm looking at the trend of job openings. I'm looking at the trend of hirings and firings. I'm looking at the trend of unemployment and by sector. I'm very focused on the construction space, we've already started to see some weakness there, which is always a precursor also. So these are, and jobless claims for sure. So I'm looking more at the trends versus particular prints or in the weeds like you're referring to. I am very worried about the AI coming onslaught to the labor market as it relates to we've built so much up in our minds about all of the productivity gains and the revenue gains, and some companies are doing gangbusters, there's no question. Others are preparing for it, and there will be a lot of transformation, and it will be to the benefit and also to the dismay. It will also have a dark side. That's why I did that column recently for clients called Recession into All-Time Highs. I still see this as, in the US anyway, as winner take all. So the Silicon Valley, tech bros are very much focused on owning as much of that market share as they possibly can, cannibalizing their own and competing with each other. It's incredible versus China, which is very much, they see it as infrastructure. So we have a very different view of this technology and how it's going to be used. But it also has a dangerous side where any other past massive capex build out has led to major retreat in stock prices, and not just the dot-com bubble, but the productivity gains follow years later, right? And the revenue gains, manifestation, I should say, follow years later. So we're doing it again. Like, we're building a bubble and a mania. We should know better. But I think that this is we already have the real economy with rising joblessness. It's already here. We don't even need AI to make it worse. So I don't know if that goes anywhere near answering your question, but I think that we have a situation where, when my title of my post was Recession into All-Time Highs, I mean, Wall Street is not Main Street, and Main Street will be hurting a lot more, and then Wall Street will follow. But it is typically, it's already here. AI just makes it worse.
Yeah, most people don't remember. Well, I'm the old guy in the room, so I guess I have to. That in the last half of 2007, Main Street was in extreme pain. Wall Street was busting out to new highs, more speculation, blockchain this, AI, you name it. They did everything crazy, just like we're doing now. Most people forget, no, this is not a direct apples to apples comparison, folks, that it doesn't require a full-on financial crisis to have a recession. Like you said, it's a credit contraction in addition. And my fear is they're just going to reevaluate how credit is measured, like they did after the great financial crisis, which brings us to real estate. And this is the dangerous part of this entire equation right now. Commercial real estate, for lack of a better phrase, is in full bore, and I'll use Mr. Awesome's non-polite version of the word, suckage. Mm-hmm. And residential real estate is starting to hurt. We're down 20% plus in most of the major Florida markets, and it's about to drop substantially more as the demographic and condominium crash washes ashore. When you start paying attention to real estate, hard assets, real land, real houses, real property, that's where I think there's some risk to the financial system from that perspective. Where do you see, first, the opportunities, and second, the danger? Because they both go hand in hand heading into a truly recessionary period.
Well, we're in a much, much better shape. That's the good news as it relates to homeowners with equity in their homes and in their incomes, et cetera. But it's definitely not a situation where I think the credit market is dangerous, like in the great housing, the housing crisis before the great financial crisis. It was a credit crisis that occurred. We have a money bubble. We have so much money. We have monetary inflation. So things, the market, metals, commodities, real estate, they have inflated because we have this money bubble. We haven't had that before, right? I mean, we had spikes of inflation that caused recession through oil. We had a credit crisis from housing. We've had different manifestations of economic slowdown, but never from a money bubble that has burst. I don't even think that was, the 1929 cause. So I don't really think we've kind of been here before. Normally, monetary inflation backdrop is good for housing, right? But it's measured in dollars, which are devaluing. So that's why the transition so strongly into precious metals for many following central banks who are trying to sidestep the dollar. I think that I've been very bullish the housing market because it was monetary inflation backdrop. Now I'm starting to get a little bit nervous, but not enough to do any, commentary on it, because I'm not a foreclosure bro by any stretch at all, because I'm an inflationista, and our greatest inflationary asset for many on Main Street is our home. So I'm going to defer, back to you if you have a better feel for that, locally, regionally, nationally. But I'm not a bull on home builders anymore. I definitely think we will have rising inflation and costs and yields, so that will keep things elevated until the money bubble bursts. And I don't know when that would be.
I'm not going to put a time frame on it, because every time I use that dartboard, I end up bouncing it off and hitting myself in the foot. So I hope that answers everyone's questions. LaDucTrading.com, LaDucTrading.com. That's LADUC trading.com. Again, at Samantha LaDuc on X, and of course, Substack. Search it, sign up for her free newsletter, then pay for it. Do yourselves a favor. So, Samantha, I've got to ask a question. My impression of the economy and many others is the quote unquote K-shaped theory. Mm-hmm. It is visible, it is viable. I wrote a piece about how I believe Amazon would never have gone to a budget grocery private brand model if it weren't for the persistent cumulative levels of inflation we've seen. This brings me to the 70-30 aspect in the K, which is why we're not in a recession. However, if we suddenly see a shift to an 80-20 or 85-15 K, we're going to be in a pretty good size stagflationary recession. And a lot of people hate that phrase, but that's the 1970s in summary. I was there in the late 70s. Trust me, when you're getting out of high school, going into college, and gas goes up to $1, you freak out. When you take a picture and snapshot of that, is that the risk you fear? A demand and credit collapse, demand for credit and product or goods demand collapse coinciding at the same time, creating the actual recessionary conditions?
This is which is chicken or the egg. I still view the backdrop that we have transitioned from monetary dominance into fiscal dominance that will show, even during a recession, that long bond yields in monetary dominance fall. That's what folks are right now counting on. That's what Trump is promising, percent, Miran, the whole bit, versus in fiscal dominance where they do not. So that makes everything very, very different. This is more emerging market type of future than I think the US is accustomed to. So inflation and loss of real income are not contradictory in fiscal dominance. We can have both. And not as bad as Argentina, right? Their real income has plunged for decades. They've had massive inflation. But you can have a credit crunch and inflation in fiscal dominance. And that's what I see us having. Does that make sense?
Absolutely spot on, perfect, because the game, the way they're playing it, and I saw this with the article on Reuters about FICO, their shares surging, Free Isaac, as the government has allowed them to sit there and use that scoring system for mortgages. Well, folks, if you're not paying attention to this, this is the plumbing that Samantha referred to earlier. If you're able to increase the credit scores by changing the system and measurement, it justifies our government, the taxpayers, buying the mortgage-backed securities and more garbage subprime real estate loans being issued. This is how we got into the problem in the past. And it seems to me your theory of an inflationary situation with stagnant growth and an attempt to use fiscal dominance to push it through is only going to make the inflation worse, much worse.
Higher policy rates only feed inflation and inflation expectations. They increase debt servicing costs. I mean, that's just how it is. And it doesn't even matter if we go to war or we have some more printing of dollars to finance wars. Recession, you get high yields in fiscal dominance. So this is where I am, kind of focused on what will trigger first. The labor market weakness will manifest itself, if not in Q4, then next year. And obviously, Trump has lots of tools to pull out of the toolbox to try and repress yields and devalue the dollar and also keep a collar on oil price. And he's done that very, very successfully, by the way, all three things. But in a time when you start to get sovereign insolvency, because is when the government starts to kind of paper over the problems with QE, and that's inflationary. So then the future goes to shit, and that causes yields to rise to compensate for it. So if his plan, it's also about the rate of change. If the dollar just falls very slowly, like it has, we're down 10%, whatever, market is up, that's helpful to the market. But if the dollar starts to fall at a rate of change, that's very destructive. So that's what I'm watching is how tightly can Fed, Treasury, White House control the falling dollar and try and get yields down through this quote unquote soft landing when in fact term premium is rising all around the world. Rates are rising. Long-term interest rates are rising across the G7. And we're like, what, 60% of them have done rate cuts, but it didn't matter. Yields and term premium are still rising across the entirety of the G7. That means their monetary policies are not working in fiscal dominance, full stop.
And with that, I wish to thank you once again for joining us, answering my geek out questions, because it's some of the things I enjoy doing. I really like to provide your perspective to the markets and to the macro economy. Jeffrey, by the way, if you guys do not follow Jeffrey, he's absolutely fantastic. Yeah, him and I barter. You see him and I bantering back and forth all the time. It's one of the key things that if you're not willing to engage and ask questions and offer opinions, what's the purpose of social media? That's my whole point.
Yeah.
And this is where having this forum is fantastic to have you on board with us.
Oh, thank you. And I honestly, I run live trading rooms, right? Like I have focused on chase and swing and trend timeframes, but my focus of having him come in to round out the very, very unique perspective about classical economics has been critical to my ability to also better time macro trends, no question, or to have higher conviction in the trends, because now I understand much, much better what has happened in the past, right? And how this can morph into the future from a precedent standpoint. And monetary policy is how I was trained. Most of us were trained. And this is gone. This has been replaced. And that's why it makes it very difficult to appreciate how disposable income is falling when they're measuring the wrong thing. Or unemployment, isn't scary yet, but it will be, because it affects consumer spending and, everything is obviously tied. But I think this is going to be a very interesting 2026, but that doesn't mean we can't have a crack up boom type of parabola, right? And so, and you know that because I have posted this, we have still the potential to reach 6,500, 7,000, 8,200. These are levels that will create a parabola, which by the way, parabolas are trapped longs, and they trigger volatility and liquidation events. So we don't want a parabola. People think they do. They think they can time it perfectly. And they know melt-ups always result in meltdowns, but they still want it. It's fascinating to me, but we really don't. We really, really, really don't. So hopefully we can get some things in order from a fiscal standpoint, but gold is telling us that we can't.
Samantha, thank you so much. And your parabola of reference that you're speaking of, that I remember first when I just left college, was 1987. And that was a fun one to watch live on Financial News Network, let me tell you. Please promote your websites, promote your Substack, and please come back to our show again. We enjoy having these discussions, and we like being able to go a little bit into the weeds to see what's happening behind the big picture and not these flashy headlines that we're all supposed to absorb and believe in religiously.
Well, I appreciate it very much. It's a joy to talk with you too, because you get this stuff. we can talk about the macro, and it's not, bear porn. It's consideration, and it's awareness, risk awareness. So we can trade tactically. We trade what we've got for the market, but we absolutely have got to be mindful of what is ahead, and it is very unnerving at times. So, don't stay on the dark side too long, but definitely we'll come back and talk and see how we're doing in 2026. Hopefully, we'll get a little bit of relief here on a short shutdown, but I'm color me skeptical. In the meantime, enjoy your crack up boom phase before a more serious correction ensues.
Samantha LaDuc, everyone. Fantastic. LaDucTrading.com. And if you don't know what a crack up boom is, research it. If you don't, Google it. Absolutely. And one more thing, folks. If you're a day trader, and this is friendly advice from someone who's put enough self-inflicted wounds into his own personal account in his lifetime, read Jesse Livermore. Study up on the mistakes of the past. That's how you avoid bigger mistakes in the future. For MacroEdge Radio, if the weather gods will finally cooperate in the tropics, I'll be in Naples next weekend. But yeah, I love. Where do you go on vacation in Florida, but to someplace more expensive and stupid than where you live now? So it's what we do. And if I'm here next week, I'll let you know on X. Otherwise, we will see you in 2 weeks on the 17th. I don't know if Don and the team are going to put together a show with me being out of town. If not, that's fine. We will make it happen one way or the other. For MacroEdge Radio, thanks again to Samantha LaDuc.